a central bank performs 5 basic functions. 1, acting as a banker to the central government. 2, acting as a bank to other banks. 3, acting as a regulator to banks. 4, conducting monetary policy. And 5, supporting the financial stability of the system. The first 4 functions give an economy's central bank, in the U.S.'s case the Federal Reserve, immense control over the size of M0, the money base of the economy, but only what would best be described as significant but limited influence over the money supply, akin to what has been described as pushing against a string. But this is why a conversation around money has to involve the Federal Reserve, otherwise known as the Fed. The Federal Reserve System is the central banking system for the United States, established by Congress in 1913 in the wake of one of the nation's worst economic recessions up to that point. The banking system is made up of 12 regional banks, a structure put in place to appeal to political concerns about concentrating monetary power in any specific area of the country. The Fed is considered a quasi-public institution. Although the bank operates as an organ of the government, given its powers directly from the elected representatives of the United States Congress, private banks in each region are effectively the shareholders of their regional Federal Reserve Bank, which in turn gives them the power to elect the board of directors of their regional bank. Each regional bank's board can then appoint its bank president, but these regional banks also kind of act like bankers' cooperatives, as the owners of the regional bank are also the members subject to the bank's enforcement and regulation. Yet, the public influence in the Fed's governance is why this is a quasi-public institution. The Board of Governors is in charge of overseeing the 12 reserve banks. The 7 governors are appointed by the President of the United States, or POTUS, and then confirmed by the Senate, the executive and the highest legislative house, respectively. Both bodies are elected by the nation's voters. The chair and the vice chair of the Federal Reserve are appointed by POTUS from among the governors. This means that while the Fed is theoretically owned cooperatively by its private member banks, who are shareholders, the oversight of the regional Federal Reserve banks is determined by federally elected officials. On top of that, the Fed exists because of a congressional mandate and could be ended, have its powers expanded, or have them restrained at any time by Congress. The Board of Governors are appointed to 14-year terms to detach them from the 2- and 4-year American political cycles, although POTUS does have the power to remove a governor for a cause. An issue that was most recently raised before this video's publishing by President Donald Trump in regards to the Fed chair he appointed, Jerome Powell. To be sure, independent central banks have been demonstrated to be beneficial for their economy's growth. So it may be good that, for example, the Fed is authorized to purchase and sell U.S. Treasury bonds, meaning that it can make a profit to fund itself separately from Congress's fiscal policy activities. Those earnings are limited, and their profits after compensation, shareholder dividends, and a predetermined approved account surplus are given to the U.S. Treasury. Still, no legally sound decision made by the Federal Reserve has to be approved by either Congress or POTUS, although in some special circumstances the Fed's powers will be temporarily expanded. The Fed's strongest and most consistent powers stem from what we call its monetary policy-making authority. It can enact monetary policy, which is policy meant to influence, for one, the money supply, through 3 main tools. Those are reserve requirements, credit facilities, and open market operations. The first, reserve requirements, means that the Fed can set the ratio of reserves nearly all banks, not just a few that are members, must hold in relation to their deposits. This is the least adjusted tool, though, as changing reserve requirements is something like using a hammer to press buttons on your remote. It's a blunt, moderately unwieldy tool for a task that usually needs measured responses. Also, while in theory increasing reserve requirements would contract the money supply and vice versa, in reality the connection may have been severed during the financial liberalization of the 1980s. What we see now is evidence that more so supports the theory that banks and borrowers effectively determine the efficient size of the money supply and then seek to reserves to legally support the equilibrium supply. Credit facilities fulfill the Fed's role as lender of last resort to banks and as a bank to the government. In moments of economic crisis, the Fed has opened various kinds of credit facilities designed to meet the needs of cash-strapped firms and state and local governments. But they also have a consistent tool for offering credit to members. When a member bank falls short on reserves, they can borrow from the Fed at the discount rate, which is set by the Board of Governors. Lowering and raising the rate makes it cheaper or more expensive for banks to borrow more reserves. Banks can also borrow reserves from each other at the federal funds rate in the federal funds market. And although the Board of Governors has direct control over the discount rate, the Fed really enacts monetary policy by influencing the federal funds rate through the addition and subtraction of reserves from banks, particularly through the Fed's open market operations. Notably, the Fed's role of lender of last resort might be exactly why the loan's first approach to modeling money multiplication most appropriately describes the real world. If banks can always borrow reserves from somewhere, they have less reason to consider it as a limitation as much as a residual dealt with after the bank figures out the most efficient amount of loans to make. Open market operations are the final monetary policy tool in the Fed's kit, and probably the most powerful. By buying or selling government bonds, IOUs issued by the federal government with the promise to pay the holder a lump sum or a set of payments, the Fed can change the amount of excess reserves held by banks, buying bonds to add to the sale money to their reserves and selling bonds to remove the sale money from their reserves. Of course, these reserves make up M0, or the monetary base for the U.S. economy, meaning that the Fed's open market operations can change the size of the U.S. money supply, influencing macroeconomic performance, even if with price level effects. Mechanically, it makes sense. If the required reserve ratio is on average 10%, then every dollar the Fed adds will multiply into 10. And since all of the other types of money supply, M1, M2, etc., are extensions of the monetary base M0, it means that the government's monopoly over money is really a monopoly over money's contribution to price level changes. Theoretically, the nominal size of the U.S. economy can change just from monetary policy actions. So controlling the money supply acts as a sort of control valve on how much of a change in nominal GDP comes from inflation or deflation. But remember, in reality, banks are probably leading the way in determining the size of the money supply, not the Fed. So while open market operations can change the monetary base, the channel connecting the base to the money supply is likely broken, especially when the economy is in a dire state and banks and borrowers have less of an appetite for risk. What open market operations are more directly doing is changing the amount of reserves banks have to loan each other, which does have an impact on the federal funds rate, the rate at which these banks loan reserves to each other. My series of videos on monetary policy go more in depth into how the powers of the Fed can impact the macroeconomy. But it's important to note that the Fed's open market operations aren't just inflationary or deflationary, because by changing the money supply, they implicitly change interest rates across the economy, presumably by changing the rate banks charge each other for borrowing reserves, the key they need to legally support their loans. And those rate changes impact financing costs for real consumption and economic investment. More on that in my videos on bonds, interest rates, and financial markets.